Are you following a stock or index where there's a fairly clear level of support and resistance, but you just can't find a good entry point that gives you the proper risk reward on a trade? I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the professional traders on our desk have a number of solutions to this problem that can be extremely powerful if applied with a little bit of skill. In today's video, we'll be sharing with you a very effective technique where you don't really need to time your entries very precisely. You just need to know where support and resistance are, and the strategy will do the rest for you. So if that sounds like something you'd like to learn about, then I'd stick around because I think you're going to find this pretty cool. Hi, I'm Seth Freudberg. I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so I'm sure that there is some stock or some index that you follow which has established a fairly clear support and resistance area, but you're having trouble finding a good entry point for the trade. And that can be frustrating if you have conviction about a trading idea. And to give you an example, I'd like you to take a look at a chart of the RUT index, which is the index of small cap stocks for the year 2021. And as you'll see, from April through August, the index had trouble getting past that 2340 area on the upside and consistently found support in the 2130 level month after month. So it wouldn't be unreasonable to think that those could serve as reasonably comfortable support and resistance levels for the index, at least for the time being. And so there's a strategy well known to options traders known as the calendar spread that can be used in these instances in order to profit from an index where there are definable support and resistance areas. Now, before we get into the details of how the calendar spread strategy works in cases like this, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing right now at the top right corner of your screen. That's going to open up the free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. To explain how the support and resistance strategy works, we need to make sure that everyone watching the video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. All right, so the best way to understand how index options work is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 4032, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 4075 call, that one would expire worthless as the index didn't close above 4075, so the call seller just gets to pocket the premium he collected. And the puts are just the opposite. If the market closed at 4032, then the 4075 put would be worth $4,300 because the market closed 43 points below the put strike price of 4075. But the 4,000 puts, they would expire worthless because the market didn't close below the 4,000 strike price. Okay, so with that in mind, let's zero in on the afternoon of August 12, 2021, when the RUT index was trading at 2242, which is pretty much halfway in between the support and resistance levels we just discussed. And suppose that we went ahead about 6 weeks into the future to the September 24th options chain, and we sold 10 of the 2340 index calls right at that resistance area we talked about, and simultaneously bought the same strike 2340 calls expiring about 3 weeks later, and then went down on the put side and sold the 2240 puts right at pretty much where the market was trading, as well as the 2130 puts right at that support area we discussed. And again, like with the calls, we bought the same strike puts on the October 15th chain corresponding to the puts we sold. Well, when we do that, we have entered into basically 3 calendar spreads, known as a triple calendar, with the bottom and top calendars at support and resistance respectively, and the center one, the put calendar at 2240, about halfway between them. Now, let's first break down the cash flow of this trade so that you'll understand its dynamics. You see, when you sell the September calls at 2340, you receive a price of $21.65. But since each call pays off at $100 per point, you multiply that by 100, and you sold 10 of them, and so that results in total positive cash flow from selling those calls of $21,650. And by that same logic, you brought in $65,832.6 from the 2 put positions you sold. Then moving to the corresponding October options that you bought, you can see from the calculations that the October options in total actually cost more than the cash you received from the September options, resulting in negative cash outflow of $40,650 for the initial position. In other words, you spent $40,650 to buy these 3 calendar spreads. And that makes sense, of course, because the options market will always charge you more for an option at the same strike price in a later expiration chain than it will for options in an earlier expiration, because the market has more time to make a move towards one strike or the other. Okay, so now let's move forward to the day that these options expired, which is September 24th. And as you can see, on that day, the RUT index closed at 2248, having continued to channel such that the index actually never got back up to the resistance area again during the course of the trade. And in late August, the 2130 support level held again. And so traditionally, on the final day that the short options expire, a calendar position is closed. And since the September options have just expired, the only thing that the trader would have to do in this instance is to sell off the long options. So I'd like you to focus on those for a moment. And as you can see, those still have some value because they don't expire for 3 more weeks. And as you can see, the 2340 calls are valued at $8.60. The 2240 puts are valued at $38.79. And the 2130 puts are valued at $13.20. So let's now break down how the trade would have come out on this day. And so focusing first on the options expiring in September, well, the 2340 calls closed above the index price, but they only pay off if the index price is above the strike price, so those go out worthless. And the 2 puts at 2240 and 2130 are both below the index closing price, and they only pay off if the index closes below their strike prices. So those go out worthless too, meaning that the only value left in the position are the long options still alive in October. So let's see what happened with those. And as you can see, each of them still has a value because, of course, they won't expire for 3 more weeks, and the chances of the RUT index getting back up to 2340 are still pretty high, being 100 points away with 3 weeks to go. And of course, the 2440 put is right below where the RUT closed on this day at 2248. And so that actually has a lot of value, as you can see. And the 2130 still has some value as well. And so if you sell them all and add up the proceeds, you still have plenty of cash to collect from selling off those long options. And so when you subtract out the original cost of the calendar, the triple calendar spread, you'll have a profit of over $19,000, which is a 49% return in just 43 days. And so what's the basic dynamic going on here that gave us such a great result? Well, first of all, we had a situation where the RUT index continued to stay inside the predefined support and resistance range. That's a very important part of why this trade worked. But the truly important principle work is the fact that when you first enter into the trade, you're buying those long options in October and basically reducing the cost of those by the cash you received from selling the short options at the same strike prices expiring earlier. However, if the RUT doesn't move and all of those short options expire with no value, then when we want to go ahead and close the trade, we literally won't have to pay anything to close those short options, whereas we're getting paid handsomely for selling the remaining value in the long options, which will almost always be a significantly higher value than what we paid for entering into the calendar spreads in the first place. Or put another way, the reason the calendar spreads work is that the time value of the short options always dissipates to nothing at the end of the trade, while the long options lose their value more slowly and still have plenty of value on the day that we close the trade. And that's how a calendar spread provides a profit. And so what I'd like you to take away from today's video is that there are many ways that options traders can take advantage of a market that is just channeling between support and resistance. And the triple calendar trade is a great way to do that. By placing a calendar spread at both support and resistance and another one centered between the two, there will be many cases where that trade offers an excellent profit opportunity as long as support and resistance are not too far apart. Professional traders have tools that can help them determine many of these factors that will provide the basis for a solid triple calendar trade, and many of those tools are available to the general public as well, which is a subject we can cover in future videos. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.